This is a recording for advanced consolidation, advanced group of accounts. I would want to welcome you all to our presentation today. And my name is Paul Mpalawe, and I'm a certified chartered accountant, a member of the Association of Chartered Certified Accountants, SCCA, and I also have a Bachelor of Accountancy degree with a credit obtained from the University of Malawi, the Polytechnic. Now it's called Malawi University of Business and Applied Sciences, MUBAS. Our discussion today, we're going to zero in on changes in a group structure. And this is a complex area. Why is it a complex area? Because there are things that we need to understand fully if we want to be equipped fully as far as consolidation is concerned. So our main objectives in our discussion today, we're going to discuss and apply the implications of changes in ownership interest and the loss of control. As we discussed earlier, a parent company becomes a parent company when it has control. So control at junior level understanding, we learned that it's just getting more than 50% shares. But later, after understanding fully IFRS 10, we saw that apart from getting the more than 50% shareholding capacity, what any other things mandates the parent company to have a full control. That's when we looked at the exposure to the profits of the company. It's number one. Number two, control, and that aligns with the voting power of the parent company. So there may be instances in the year that there may be a step acquisition. For example, a parent company may obtain or may acquire 60%, then within the year, it may also add more than 20% to make it 80%. So in such instances, how do we account for such a transaction? And there are also instances where the parent company may lose control. From acquiring 80%, it can sell those shares, let's say 40% of the shares, and remain with 40%. That's when we look at disposal. Hence, the aspect of complex chips in. So that's largely our discussion today. And we're also going to prepare group financial statements where activities have been discontinued, as I alluded, or have been acquired or disposed of in the period. And the third objective is to discuss and apply the treatment of a subsidiary which has been acquired exclusively with a view to subsequent disposal. The parent company can just acquire a subsidiary and later decide to dispose. If that happens, how are we going to account? So acquisition of the subsidiary, basically there are two. It can happen within the mid-year acquisition, where the parent company has already started trading, and 6 months down the line, the parent company would acquire a subsidiary. How do we account for such? That's when we look at an aspect of mid-year acquisition, where we use the proportionate number of months against 12 months. So if we acquire within 6 months of trading, we say 6/12. If we acquire 8 months in trading, we say the remaining months, which is 4/12 times amount of transactions that actually occurred within the year. Then there is a step acquisition, as I explained earlier. So in media acquisition, a parent entity consolidates a subsidiary from the date that it achieves control. So the main thing to understand is an issue of control. When is a parent company obtains control? Okay, that's when we determine the number of months, number of months to ascertain to that. If this happens partway through the reporting period, then it will be necessary to prorate the results of the subsidiary so that only the post-acquisition incomes and expenses are consolidated into the group statement of profit and loss. We are looking at the transaction that happened after acquiring control. That's post, okay, post-acquisition. It's not that difficult until you understand the nitty-gritties to it. So a step acquisition occurs when the parent company acquires control over the subsidiary in stages, as already explained, and this is achieved by buying blocks of shares at different times. So acquisition accounting is only applied at the date when control is achieved. We're emphasizing an aspect of control. SBR students. In SBR, you are examined as a consultant. Being a consultant, you absorb a lot of information and you streamline this information, and so that you should be able to explain to the board of directors and those charged with governance. That's what your examiner will be examining you. How much information have you absorbed, and how quick or how possible can you solve complex matters and explain such matters? Solving goodwill alone and step acquisition, if you're an SBR student, is not enough, but being able to explain what really happened to reach that level after solving those problems, that gives you a plus and a mark in exams. So any pre-existing equity interest in an entity is accounted for according to IFRS 9 in the case of simple interest, IAS 28 in the case of associate and joint ventures, IFRS 11 in the case of joint arrangements other than a joint venture. So at the date when the equity interest is increased and control is achieved, what should you do? Number one, remeasure the previously held equity interest to fair values. That's the first point. Secondly, you have to recognize any resulting gain or loss in profit or loss for that year. Okay, whether there's a gain or a loss, you have to account that in profit or loss. All right. So number three, what do you need to do? You need to calculate goodwill and the non-controlling interest on either a partial or full basis, depending on how the examiner has put it. Sometimes you can use full goodwill. Sometimes you can be asked to calculate goodwill using partial goodwill. So at this level, you should be able to do that. Okay. So here we are showing the formula that you need to use in step acquisition. At a time when you have a step acquisition, for the purposes of goodwill calculation, the consideration will be the fair value of the previously held equity interest plus the fair value of the consideration. Okay, consideration transferred for the most recent purchase of the shares at the acquisition date. So this pro forma is the recommended pro forma that you need to use in exam. Fair value of previously held interest. We'll see how that goes with an example. You need to add fair value of consideration for additional interest that has been acquired by the parent company. Then you need also to add a fair value of NCI at acquisition. So then the total, you need to remove the fair value of net assets at acquisition. Then what you find, my friends, is goodwill. Assuming that you've got a step acquisition. Okay, so if there has been a remeasurement of any previously held equity interest that was recognized in other comprehensive income, any changes in the value recognized in area years or are now reclassified to retained earnings. We even do that in practice. Okay, reclassification of previously held interest that was previously recognized in other comprehensive income. So the final point to note on stable acquisition is that purchasing further shares in a subsidiary after control has been acquired. We give an example, taking into group interest from 60 to 75 is regarded as a transaction between the equity holders. So you don't need to recalculate goodwill in such instances. Okay. So given an example, Aya has obtained or has owned 90% of ordinary shares of Flow for many years. Aya also has a 10% investment in the shares of Brian, which was held in the consolidated statement of financial position as at 31st December 2006 at $24,000 in accordance with IFRS 9. On June 30, 2007, Aya acquired a further 50% of Brian equity shares at a cost of $160,000. So what I've done, I've copied the same example and I will share with you the Excel spreadsheet that we're gonna use in calculating this problem. Okay. So the draft statement of profit and loss for 3 companies for the year ended 31 December 2007 are presented below. Self-explanatory. Revenue for IR 500, Play $300,000, and Brian to $200,000. Gross profit 200, 230, 80. Operating cost as given. So quickly go to the question to understand what the examiner is looking for. The examiner is saying required, prepare the consolidated statement of profit and loss for Aya Group for the year ended 31 December 2007 and calculate the goodwill arising on the acquisition of Lion. So having known that what the examiner is looking for, let's quickly screen through the non-controlling interest is calculated using the fair value method on 30 June 2007 as given. Blind identifiable assets 200. The non-controlling interest in Blind to $100,000. Then the original 10% investment in Brian is 26,000. Let's look if we've got additional information. Okay. So I think you've got information to calculate to start tackling this question. Remember, as given by the pro forma, we said that goodwill represents fair value of previously owned interest, okay? Which is how much as given by the question. Previously, they owned how much? Previously, I hold as given here, the original 10% investment. So the 10% represents $26,000. So we quickly insert here $26,000. or we can choose to put a precision of 1,000 and just say 26. Then as per given by the performer, we also have to add fair value of the consideration transfer. Consideration. Fair value of the consideration that has been transferred. Here, it's Aya acquired a further 50% of Blind equity shares at a cost of $160,000. Then you also have to add fair value of NCI when at acquisition date, which is how much we're given below here. The non-controlling interest in Brian is $100,000. So we just have to insert 100,000, having a total of, let's see the sum total. $286,000. Since the company is using full goodwill, I'm gonna take the full amount, and you're gonna less. We're going to reduce with fair value of net assets of a subsidiary. We are given that amount down here, which is the identified net assets is $200,000. Less 200,000. It means that our goodwill at the date of step acquisition is the total of that minus the fair value net assets, which is 86. Okay. I hope that resonates well. I hope you understand where the 86 is coming from. All right. So what else should we calculate as per given question? Let's look below what we have. In the process of understanding what really happened, we should highlight the group structure. Okay, we have the parent company, Aya. Then we've got Play, Player. Then we've got Brian. Okay. Let's check the holding capacity. I'll just take a drawing shape from here. Aya related to Player, and same Aya related to Brian. Okay. Now let's go back and understand what really happened. So Aya has owned 90% of ordinary shares of Flare. When? Many years ago. We don't know when. So obviously the parent controls 90% shares of Flare. Okay. Which was held in consolidated statement of, sorry, Aya also has 10% investment in shares in Brian. Okay. In Brian, they've got 10%. When was this? Which was held in consolidated statement of financial position as at 31st December 2006 at 24 in accordance with IFRS 9. So previously, the parent company was accounting for the equity interest in Brian using IFRS 9 as a simple investment. Okay. Then on June 30, 6 months later within the year, Aya acquired further 50%. It means from 1st of July, the company had 60%. So this will be accounted for 6 months to year end, which is 31st of December. And the 10% will also be accounted for the first 6 months. The first 6 months from January. So that, my friends, is step acquisition. Step acquisition. On 30th of June 2006, I acquired further 50%, making 60%, 10 plus 50, for 160,000. Hence here, we use consolidation transfer as 160,000. Okay. What else do we need to account? So after the step acquisition, the previous investment of 24,000 needs to be revalued to recognize again. Since down there we were told that, down here, we are told that the original 10% investment in Brian now is 26,000 at the year end. So we say originally the investment of 10% was valued at 24,000. Now at the year end, the value of the investment is $26,000. Gain in fair value is as simple as taking 26 minus 4,000, which is $2,000. So the big question is, how should we account for that 2,000? At the year end, it means that the investment, the double entry that the company did was investment increased. So we debit investment with 2,000. Then we credit profit and loss as again. Profit and loss as again for 2,000. Okay. Now the investment held for 26,000 is included in the calculation of goodwill as we put it up there. And just to emphasize on the point that Aya had control of Brian for 6 months, from 1st July to 31st of December. And therefore, we're gonna use consolidation of 6/12 for the incomes and expenses of Brian incorporated in the statement of profit and loss. So This is second working. It was supposed to be the first working, but it is what it is. Then first working goodwill. Then thirdly, let's look at the profit attributable to the non-controlling interest. Profit attributable to non-controlling interest. We are looking at Flair here. We are told that Flair made a profit at the year end of 120. So let me put the precision here to say $1,000. $1,000. So profit of Flair, it's 120. 120,000. Since the parent is taking 90%, NCI is gonna be 10%. So when you are calculating NCI down here, you're gonna say share of NCI, share of non-controlling interest is equated to 10% times $120,000, which is 12. Then we're gonna say profit for Brian, to be incorporated in consolidated profit and loss equates to 6/12 times, let's see how much profit this guy made, 16,000. Okay, so it's a matter of saying 6 divided by 12, that's for 6 months, multiply by 16. So that's 8,000. However, since shares were adjusted from 10% to 60%, the value of NCI is going to be 40%. 60 for parent and 40% for NCI. That being said, here we're going to multiply by 40%. So the profit attributable to NCI in Brian is 3.2 million. Total profit attributable to NCI is that of Flair shares in I shares in Flair, 12 plus 3.2. 12 plus 3.2, making it $15,200. Isn't that simple? I believe it is. So after calculating those 3 items, we are good to consolidate. So consolidation would simply mean that adding right numbers. Then we can quickly pick those numbers and add. So remember to put the name of the company. Given an example, it's Aya Group. what are we doing? We are preparing group statement of profit or loss when for the year ended 31st December 20x7. Okay. So it's a matter of adding across. Okay, so we add 500 plus 300 plus 6/12 of 200 for revenue. So let's say revenue, we're gonna take 500 for iron plus 300 for flare plus open bracket 6/12 is 0.5, 0.5 times 200, which is 900. So same with COS, cost of sales. We're going to take 300 plus 70 plus open bracket 0.5, which is 6 months, times 120. That's 430. Then our GP, that's gross profit. Our gross profit is going to be 900 minus 430, which is 470. Then let's take the operating profit. OP, operating profit, you're going to take 60 plus 80 plus open bracket 0.5 times 60. That's 12 months portion. That's 170. We're going to reduce. Then, my friends, what you're going to have is profit from operations. Profit from operations. It's a matter of taking 470 minus 170. We're gonna have 300. Okay. Then we need to add the profit that we have created here again in investment. Remember, we put up a double entry to say, again, we're gonna debit investment, that's assets, you're gonna credit profit and loss. So credit shall mean increase in profit and loss. So we're gonna add that increase as a profit on the recognition of equity. The recognition of equity, since there was a step acquisition of 2, then we're going to reduce with a portion of taxation, where taxation has given 28 here plus 30 plus open bracket 0.5 times 4 as given here, and that will be 60. Therefore, profit for the period is going to be this 300 plus 2 minus tax, 242. Okay. But remember, we have to split this profit to two lines. The first line is equity. We're gonna say profit attributable to the owners attributable to owners, that's equity or equity holders. That is will be the balancing figure. This one will be the balancing figure. And profit attributable to non-controlling interest. We calculated this one up there, if you can remember, 15.2. Then it means the balance between 242 and 15.2 is the equity interest of the owners of the business. Meaning to say the total between 2 to 6.8 plus, that's equating to profit for the period. My friends, that's how we account for a consolidated profit or loss. So, my friends, here we have learned a couple of things, including but not limited to how to account for step acquisition. Okay. If you have questions, you are at liberty to drop those questions in the comment box, and at some point I'm going to address such. I hope this gives you a better overview of a step acquisition in as far as complex group is concerned. Okay. There is our solution. We're looking at 242. That's our key number. And non-controlling interest 15.2. And there are our workings as we discussed. Okay. So during the year, there may also be disposals where some shares company, the parent company may sell some or all of its shares in another entity, causing a loss of control. So possible situations will include the disposal of all the shares held in the subsidiary. Number two, the disposal of part of the shareholding, leaving a residual holding after the sale, which is regarded as an associate. Instead of having control, now you lose the control. The disposal of the part of the shareholding, leaving a residual holding after the sale, which is regarded as an investment, which is prescribed, or we use IFRS 9 to account for such. So at a point when you have a disposal, how should you account for that investment in individual financial statements? So first of all, you need to take the sale of the proceeds. Then you need to reduce that by the carrying amount of the shares sold at the date when the control was lost, or at the date when the shares were sold. Then the balance that you find there, it's either a profit or a loss. So the profit or loss may need to be reported as an exceptional item. If it's so, it must be disclosed separately on the face of the parent's statement of the profit or loss for that specific year. And there may be tax to pay on this gain, if there is a gain, that is. depending on the tax laws in the place where the parent is located, the parent's jurisdiction. So this would also result in an increase to the parent's company's tax expense in the statement of profit loss, if there is a gain, that is. Similarly, if there is a loss, obviously the company will benefit in taxes, having a loss. There is always an aspect of deferred tax asset. So to continue with the disposals in the consolidated financial statements, if the sale of the shares causes control over subsidiary to be lost, then the treatment in the consolidated financial statement is prescribed as follows. You have to consolidate the incomes and expenses of the subsidiary up until the disposal date. Okay, consolidate profit and loss up until the date when the control is lost. On disposal of a subsidiary, recognize its assets and liabilities, goodwill and non-controlling interest, and calculate a profit or loss on disposal. Okay, at such a date, you need to calculate the profit or loss on disposal. Later, you need to recognize any remaining investment in the shares of the former subsidiary at a fair value, and subsequently account for this under the relevant accounting standard, depending on the case scenario. So a holding of 20 to 50% of the shares would probably mean that the remaining investment is an associate, which should be accounted for using equity method, as we've done before. And a holding of less than 20% of the shares would probably mean that the remaining investment should be accounted for under IFRS 9, that is the financial instruments. Okay. So in a case where the disposal has happened, where control of a subsidiary has been lost, the template below should be used. My friends, this is examinable, especially those people who are writing SPR. This one here, it's highly likely and it's examinable. What do you need to do? You need to take the disposal proceeds. What are the disposal proceeds? The amount of money that you've received after disposing your shares. Then you need to add that with fair value of the retained interest. What are the retained interest? The interest at which you have, the interest that are remaining with you in that investment. The total of that you need to reduce with the interest in subsidiary disposed of. One, the net asset of the subsidiary at a disposal date. Remember, net assets. Okay? Then you need to add goodwill when at the disposal date. So you need to recalculate goodwill at the disposal date. That amount should be reduced by the carrying amount of NCI when at the disposal date. So two things that you need to calculate before calculating profit or loss on disposal is find the goodwill at the disposal date. Remember, goodwill at the disposal date. I'm emphasizing this point, not goodwill at acquisition. At the date of disposal, how much was goodwill? Remember, there may be things that happens between acquisition and disposal. That's impairment or that. Factor in those things. Find the goodwill at disposal date, then find the carrying amount of NCI when at the disposal date. The balance that you find there, you need to reduce with the total that you found here, and find the remaining amount. It either be a profit or loss. A profit when there's a positive, and a loss when the difference is negative. Here is less than here, but negative. It's either profit or loss. Okay. We've got an example here. Rock has held a 70% investment in dog for 2 years. Goodwill has been calculated using the full goodwill method. There have been no goodwill impairments to date, and Rogue disposes of all its shares in dog. The following information has been provided. Cost of investment, $2,000. Dog fair value of net assets at acquisition, 1.9. Dog fair value of non-controlling interest at acquisition, 800. Sale proceeds, $3,000. Dog net assets at disposal, 2,400. Required. Calculate looks individual financial statements. Then also the consolidated financial statements. So how are you going to approach such kind of a question? It is important to understand the pro forma, okay? Because the pro forma will stand as a guidance to the way this problem can be addressed. How much is sale proceeds? 3,000. We need to add the 3,000 plus the net assets at disposal. How much are net assets at disposal? 2.4. So what I can do, let me snipe the question in Excel and let me snipe the question in Excel, and probably our discussion will be there. Okay. Copy. Share. Okay. I'm interested to see this. Okay. So my friends, remember the pro forma, we are saying sale proceeds. How much is sale proceeds? $3,000. Then we need to add net assets at disposal, which is 2,400. Remember, and I think before we go here, let's calculate the goodwill, the element of goodwill. So cost of investment, 2,000. I think it would be fair if we calculate the goodwill. Cost of investment, $2,000. Where am I taking that? It's here. Then fair value of NCI, FV of NCI, it's given here, $800. So the total that we find there, it's 2,800. Okay. We have to reduce with fair value of net assets. How much are fair value of net assets here? Fair value of net assets at acquisition, it's 1,900. Then it means our goodwill is 2,800 minus 1,900, which is 900. Okay. What else do we need to calculate? NCI at disposal. This is week number 1. And this one will be working number 2. NCI at disposal. Which numbers are we taking? First of all, we need to check NCI at acquisition. That's our opening balance. We are given that amount here. Where is it? Fair value of non-controlling interest at acquisition, 800. Then, what has happened in the year? NCI or post-acquisition NCI will be acquisition NCI will simply be net assets at disposal, which is 2,400. Let me do this. 2,400 net assets at disposal minus fair value of net assets at acquisition, 1,900, which is here. Then the result, we need to take out 30%. Why 30%? Because Rock acquired 70%. You understand, my friends? So NCI at disposal, it's opening NCI plus the increase in profit of 150. I hope it makes sense. I hope these numbers make sense. 2,400 minus 100. 2,400 is NCI at disposal minus NCI at opening. The difference will give us, again, a movement in the NCI, which is equivalent to the profit. Okay, so the movement in profit, we need to take out 70% because the 30%, 70% is parent, was parent, and 30% was NCI. So we need to take the portion of the NCI. So at disposal date, that, my friends, is a value of NCI. It means we are good to calculate our profit or loss on disposal, where we're saying net assets at disposal, 2,400. Goodwill, we need to reduce by goodwill. We can simply say goodwill, as we calculated here, 900. Then the NCI, we need to reduce the NCI at disposal date, which is the 950. Since we are reducing, we need to multiply by -1. Okay. So the sum total from there, reducing the profits, is sum total is 2,350. So the profit on disposal is gonna be this minus this, 650. This, because it's positive, then that's gonna be profit on disposal. Okay, my friends, I hope that makes sense. And that's basically what I wanted us to share today. Okay, let's go back to our slides and check if we can discuss anything. Okay, that's our number, 650. So presentation of disposed subsidiary in the consolidated financial statements. Basically, there are two ways of presenting such the results of the disposed subsidiary. Okay. The first one is time apportionment line by line, where in the consolidated statement of profit and loss, the income and expenses of the subsidiary are consolidated up to the date of disposal. Then the traditional way is to use time apportionment, line by line, like the way we did previously on a previous example. So the profit or loss on disposal of subsidiary would be presented as an exceptional item. Secondly, you can present it as a discontinued operation, where we're saying that if the subsidiary qualifies as a discontinued operation in accordance with IFRS 5, then its results are aggregated into a single line on face of the consolidated statement of profit or loss. This is presented immediately after the profit for the period from the continuing operations. Okay, we have done this before. So this single figure comprises of what? The profit or loss of the subsidiary up to the disposal date, and the profit or loss of the disposal of the subsidiary that has actually occurred. So just one line. We have the first line, the continued operation, and the second line at the far end of the profit or loss, we show the discontinued operation. So it's as simple as that. Okay. So control to control scenarios, we also must emphasize on an aspect of control to control scenarios. Share purchase that have led to control over another company being obtained, and share sales that have led to control over another company being lost. Some share purchases will simply increase an entity's holding in an already existing subsidiary. So an increase in the shareholding, we don't have to calculate a gain or loss. And some shares will just be a reduction in the shareholding, not really a loss of control. So increasing a shareholding in a subsidiary from 80% to 85%, when such thing happen, what do we do? So when a parent company increases a shareholding in a subsidiary, this is not treated as an acquisition in a group of financial statements. Okay, it's just, it just affects the equity element, a movement in the equity holding. However, the NCI holding has increased. So if the company was holding 80%, the NCI was 20%. If now the company is holding 85%, how much is the NCI? It's only 15%. There's a decrease in NCI from 20% to 15%. My friends, you must understand that. So the account treatment for that transaction, where the NCIs are reduced, the effect is on the NCI and the equity. So the difference between the consideration paid for the extra shares and the decrease in the NCI is accounted for within the equity element as already alluded to. So you must note that no profit or loss arises on the purchase of additional shares. Goodwill is not recalculated. I'm emphasizing on the point to say, don't calculate goodwill again if there is no loss of control or gain of control. It's just a movement in the equity element. So credit cash paid for that portion of shares that have been acquired and decrease in the NCI. That's a double entry. It's as simple as that. So the decrease in NCI will represent the proportionate reduction in the carrying amount of the NCI at the date of the group's additional purchase of shares. Okay. I think we should stop there for now. And I believe that this discussion has opened your eyes in step acquisition and step disposal, which is termed as complex group of accounts. And I believe that this information will go a long way in helping you to understand further the complex group of accounts. And I believe that this will help you to envisage in exams and possibly pass on the first attempt. SBR students and financial reporting students, F7 students, and those who are doing degree at university. I wish you all the best as you continue to follow my next videos. Thank you very much.